Good afternoon, everyone. Make yourself comfortable. We're just sitting here for a moment, just waiting for everybody to join in. Thank you, everyone, for being here. Sun is about to fall here, so excuse if you hear a noise. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. This is Options Replay, strategizing your options trades. Our guest speaker is Brandon Wendell, and we'll pass the microphone over to him in just a moment. I just have to do the intros and the disclosures before we begin the class. And I just want to say that these is one of those classes that I enjoy a lot because it's a very practical in its in the way that is presented. We look at examples that are real, trades that you could have placed, and we go through all the different aspects of that trading transaction, whether it works or it doesn't work, why it works or why it didn't work. So we have our hands pretty much full for the next 60 seconds. I mean, 60 seconds, 60 minutes to talk about some trading activity that Brandon has identified in the prior weeks. So before we jump over to him, let me show you where this class is being recorded and where you find prior sessions. So on the TradeStation website, if you go to the main menu right here at the top and you hover over Learn, you'll find Options Education. Once you go to the Options Education Center, all you need to do is scroll a little bit on this page, and you'll find a big box that says Options Replay, allowing you to join the upcoming webinars, which if you're already registered, I think it automatically sends you a reminder every time that we do one. But here you can watch the previous presentations. They may not be very timely because it happened a few weeks ago. However, we do present different strategies or different platform technology that you may not be aware of. These presentations have a unique name so that you know what strategy was highlighted or what type of topic was covered. And we do this with all the Options Replay presentations. So today is no exception. We're going to go through some trades, and Brandon already told me that he found some interesting opportunities in the market. So we're going to get to him in just a moment. Just a few disclosures. Keep in mind that every symbol and idea that we talk about is going to be for educational purposes. These are not recommendations of TradeStation. Also, active trading is not suitable for everyone, especially when it comes to trading options, which carry a higher degree of risk. We all need to be aware of the risk associated with trading online. So please, if you have any questions or you need a little bit more details on these disclosures, go to www.tradestation.com/important-information. Also, one thing, Brandon Wendell, although he's a guest for TradeStation, he's not affiliated with TradeStation, but we do enjoy his sessions and we do appreciate the time that he spends with us sharing his expertise in trading. So that's it. I'm going to mute my microphone and stop my share. I'm going to pass the microphone over to Brandon. Brandon, the floor is all yours.
Let me go ahead and I'll share my desktop with you guys then, and we'll get this going. So always technology, fun stuff, right? Should be able to see my screen too. Cool. We're good to go. All right. So welcome back, everybody. And when we were together last, we talked a little bit about straddles and strangles, and I want to kind of continue on that vein a little bit. I also did get an email and wanted to respond to something in the email as well, which is a good thing. If you guys have questions about things we're going over, again, you can always email us at education@tradestation.com. Well, it's not me you're emailing. You're actually emailing Jesus and his team, but they let me know what's going on because obviously I'm here as a guest. Just real quick, my background, I've been trading for almost 30 years, been involved mostly in the futures and options markets, a little bit of Forex, a little bit of stocks, charter market technician, which means I've got a master's degree in technical analysis. But really what I'm here to do is talk a bit about TradeStation's Option Station Pro and how to affect a lot of the strategies that you might have learned using the Options Education Center to, find opportunities. You go to the Options Education Center, you digest the information there, and then you come here to TradeStation or to Option Station Pro, which I have, where is it here? There it is. And you're like, okay, now what do I do? right? It's like, okay, great. I got all this information. I know I want to put on a bull put spread or a calendar spread or whatever it may be, but how do I do it? How do I go about that? Well, obviously, there's a lot of getting started videos and things that Jesus has put together, but I also want to try to make it a little bit easier for you by walking you through it step by step. So when we got together last, it's been a little while here. We had a holiday in between, but I remember we put on a couple of trades here in Hershey. And if I go back to, there it is, my trade manager window, I actually already did this to keep, cut down the time a little bit, but under my trade manager window, I opened it up and I went into my orders and I did a back, just ran the history real quick and found under filtering for HSY that I had put on 3 different straddles. And remember, I was using this as an example, not saying that this was going to be a good trade, but it was just an example saying, okay, we can put on a couple of different straddles based on Hershey releasing earnings on February 6th. So there's still time left until these earnings come out, and we'll follow up again in the next session to see how they do. But February 6th is the earnings release. I chose 3 different series of options, and you can see they're all put in pretty much at the same time within a few minutes of each other. Um, they're all the same strike price, which is 160. And the reason why they were all done on the same strike price is that that was the price at the time. It was at the money. So here I am on the wrong security, but let's go HSY. There we go. And going back to the 10th, there we are. You can see that pretty much middle of the day, close to the end of the day, we were trading right around 160. So I put on that at 160. And again, the ones I chose, and I'll go to my Option Station Pro, and the Manage tab is where I can see my options position. So I have several different other positions available and open right now. We'll talk about those in a little bit. But it's focusing on Hershey. What you'll see is I chose February 7th, which is one day after the expiration. I chose February 14th and then May 16th. And one of the things you might notice right away is the 2 that expire in February, a week apart, have the greatest loss so far. Meanwhile, the one further out in May has less than half of a loss compared to the other 2. So what do you think is the biggest contributing factor? Obviously, they're all the same strike, right? The big difference is time. That's really what it comes down to. This is a debit strategy. And whenever you're dealing with debit strategies, you're at the mercy of time. Okay. When it happened, again, I go back to the basics of options and the Greeks and looking at an options chain. For instance, if I bring up Hershey, here's an options chain, and I'll just bring up, it doesn't matter. I could have kept that one open. Here's 3 days left till expiration, and I'll just bring up the strike price is 10 strikes altogether. So we have the at the money options right here in the middle. We're trading currently at 153.72, so we'll call it 154, a round up. So we're right in between the 152 and a half and 155s. Okay, so that's the at the money level right there. And what we basically have happen is that when we buy options, we are buying positive delta because, well, it depends on what we buy. We have positive delta for the calls, negative delta for the puts, okay, because that means positive delta prices go up when the underlying security rises. Negative delta, the value goes down when the underlying price goes up. It moves opposite, it's negative. The gamma, that's a function of acceleration. I want to change a few things here. So let me customize the columns. I don't need everything there right now. Just focus on the Greeks. There we go. I don't have rho up there, but it doesn't really matter much. Rho is for interest rates, but gamma is a rate of acceleration or change in the delta. But you'll notice theta and vega, those are going to be some of the biggest influences on us, especially when you take options that expire sooner. For instance, we were looking at February 7th, 14th, and then March. Let's see. Oh, wait, did I go out to May? Is that what it was? I thought it was March. Oh, no, it was May. I went way out. Good. I wanted to. And here's the reason why. When you take a look further out, what happens is you got these Greeks are risk management. They're risk parameters. And we do spreads. I think I mentioned this before, because if you just choose one option, you're at the mercy of whatever Greeks you have. But when you do a spread, you're creating one option and then using another option offset some of those Greeks that you don't like, or maybe you're worried about, in this case, a straddle. Okay, we're getting both a call and a put. So we have positive delta and negative delta. Therefore, we're delta neutral for the most part. We're trying to balance out that delta so it doesn't matter which way prices go. But because we are buying, we are going to be faced with volatility as a factor because we have positive vega, meaning if volatility rises, that's a benefit for our position. Okay, anytime it's a positive, typically it means it's benefiting your position. So vega, and you'll see vega is positive on both sides, calls and puts. So if you bought the call and put, you had a positive volatility response, meaning if volatility goes up, you profit. If volatility goes down, you lose. Now, one thing you have to realize about volatility is if you want to reduce the effect of volatility, you go shorter term. And you can see right here, if I go to the shorter term options on, well, 10 days left till expiration, we have 9 on Vega on the call side. Same thing on the put, really. It's both the same right there. So 160 and it's 9 cents. When you go to a week later, now you have 12 cents. So you've increased your exposure to the volatility by quite a bit. What is that about? Well, 25% more, basically, right? You have 9 and up to 12. Well, if we go to the 109 days left in May, we've gone all the way up to 33. We've more than doubled our risk exposure to volatility. Now, is that a problem? It depends. If you buy options with low volatility or relatively low volatility, that's a good thing. Then we may want to buy further out because, yes, you will spend more in premium. You can just compare these two. This 160, you can see we have to pay, whoops, either 340. Well, the spread's really wide because it's after hours now. It's not normally that wide. But here it drops down to 690, or it goes up, excuse me, it goes up to 690 for 340. So the price goes up quite a bit, but you're going to be getting more of a benefit from volatility rising on this longer term option. Plus, if you sell it soon enough, you'll get most of that time value back. And that's the other thing. The further out you go in time, you can see right here, 13 cents in volatility, or I'm sorry, time, theta, versus 4 cents. The further out in time you go, the lower you have exposure or less exposure you have to time decay. So, as a rule of thumb, when I'm trading options and I'm doing debit options, debit strategies and spreads, I typically want to buy extra time and I want to be out when there's 30 days or less until expiration. So, if we want to go back and take a look to see, okay, why is this so much more negative than this? Well, the real reason is time, or it could be volatility. Let's take a look. If we take a look at the chart, actually, I'll go to this one. There we go. This is Hershey as well. And I should probably put in a vertical line there under, let's see, drawings and vertical line. Where's the right day here? 15th. There it is. There's the 10th. And the reason why I zeroed in on that day, that's the day that I entered the position. Nope, let's see. That's good enough. You can see that the 160 puts should be in the money. The 160 calls have gone out of the money, but volatility right here, implied volatility, historical volatility, it's pretty much stable, isn't it? It went up a little bit. There's the volatility. Actually, let's just get rid of this one. I'll disable that for now. And here is implied volatility for the options. And you can see it was sitting right around 26.19. And currently it's at 26.86. So it really hasn't changed much. So volatility hasn't been a factor, has it? It's gone up a little bit, but not by much. It actually went all the way up to 29, but then came back down. So what we can see is that on these options with the Greeks that we're dealing with right now, we didn't really gain anything from the volatility at all because it's pretty much right where it was. And was it relatively low when we got in? No, not really. Go back again. This is relatively low. That would have been probably a better opportunity to buy in at 22 because we would have had 4 points of volatility increase. Well, you multiply that Vega by 4, and that's how much of an increase we would have had in premium based on the volatility. What you want to avoid is buying options when volatility is very, very high and collapsing, because you can see this dropped in just a matter of days from 35 down to 27, 26, 25. I mean, this was a little over a week and a half, and you lost 12 points of volatility. That's a pretty big move, and it'll impact your option premium dramatically. Now, the other thing that I mentioned was I typically want to buy time, and this is what hurt that option position. You can see that looking at the different positions here, we only have a 165 loss on this May option because there's very little time decay that has occurred. Take a look at the theta, as a matter of fact. And can I adjust the columns here too? Customize, perfect. Let's go get the Vega in there as well. And we'll move that up with the other Greeks. There we are. Perfect. So you can see that my volatility exposure on the longer term options is 66. It's quite large compared to the rest of these. So that would actually help quite a bit had I bought it at a lower price, or even that 3% increase that we recently had in volatility. That's 3 times the 66. That would basically get us pretty close to break even, if not actually profitable, even if the prices don't move anywhere. It would overcome the time decay that we're experiencing. But what's hurting these other positions, look at this. Every day that passes, we lose $7.69 on the May options, but we're losing $22 and $30 on the February options. That's where you got to be careful. Yes, this was cheaper to get in. This was $9.50. This was $18.45 to get in, but look at how much it's decayed. I'm sorry, that's priced now. Sorry. That's the trade price right there. It's $12.70 to get in. It went up to versus $20. So not even quite double, but the decay is much greater and the loss is much greater because we have that time decay that's hurting us. So we got to be careful if we're looking at these options. And that was one of the strategies that's in the option strategy. I'm sorry, options education. Sorry, I'm dealing with the sun right here on my screen. It's hitting my face now. Got to put a curtain up, but that's okay later. Getting back to these options again, if we're looking at strategies, then in the Options Education Center, you do have, here we go. Whoops, I had it. Now, straddles for earnings as an example. Come on, shrink that back down because we're still in the middle of earnings season. And right here, we can take a look to see options are securities that are having earnings release in the next 25 to 35 days. Those are kind of in the wheelhouse for that particular strategy. But because we're going to be in the trade for 30 days or less, you don't necessarily want to trade options that are going to be expiring just after the earnings release. You want to still maintain a position that will have at least 30 days after the earnings release. So again, going back to the positions that I was choosing, and we'll see how this works out in February. We don't have that much longer to wait, to be honest with you, right? As a matter of fact, what do we see on the 7th? We have how many days left? Because it's the 6th for the earnings. 10 days left. So actually our next time together, we'll be able to see the result of all this and how much the prices actually move and how we actually manage and exit these types of positions. So we're getting 3 little versions of this. If you go to the last version, we were together, we started talking about these different positions. I put these on and we're kind of maintaining them now and seeing what's happening, and what's affecting us is the time decay. Now, what we need is a very big move in price to overcome that time decay. That delta needs to be overcoming the theta, and it may not have enough except for on the one that didn't decay that much. Does that make sense? Hopefully. Again, we go look at the open positions here. We need to overcome that time deficit. It's almost $400. It's interesting because the 14s actually decayed more than the 7s. And that could be a function of the pricing of the options as well, and maybe the volatility of the individual options as well. Okay, so that's something we can compare, and we'll contrast and compare that in just a little bit. So that's something I wanted to address, one thing. Another thing I wanted to address, let me see if I have it here. Oops. Cannot get to the right page here. Sorry. All right. So I think it was Diego. I wanted to thank you for your question. After listening to my very educated presentation on zero DTE and replaying it, tried practicing a couple of times and had a couple of curious observations. Getting orders filled was rather difficult, especially after 1 p.m. Yeah, I mentioned I do the zero DTE myself pretty much every single day. I've been doing this for many, many years. And it says several orders were filled at the same premium cost, irrespective of what you put in. Well, it depends on how you place those orders. So I'm doing those orders, first of all, on zero DT on the SPX, which is SPXW.X. And let's see here. Go to options. Here we are. Nope. Did that change over? Hold on. This is still on Hershey. There we go. Took a moment to flip over. All right. Oh, and it looks like we had two here. This is something you got to be careful of. Is that right? Oh no, it's not. It's not tube. It's because they already expired on the 27th. So we do have the 28th for tomorrow. So we're good. I was gonna say because there's AM options, but these are the PM settled options anyway. That's the one thing you got to be careful of. This SPXW.X automatically brings up the PM settled index. With the zero DTE, you do not want to typically trade the AM settled index options because they finish trading at 4 p.m. on the evening stated, the 27th, for instance, but then the settlement price is not until the next morning. So to avoid anything like that, I use the PM settled, which is the symbol $SPXW.X. Now, when you're trying to get these orders filled, yeah, there's enough volume. You shouldn't have too much of a problem. The liquidity can be a little bit of an issue later in the day. Okay, and let me customize these columns. I'm going to not really worry too much about the Greeks this moment. Now what I'm going to look at more is going to be the volume and the open interest. There we go. And you can see these are pretty liquid options. As a matter of fact, I think this is probably the most heavily traded option in the world, not just in the US, but literally in the world. Okay. And even for tomorrow, and we'll compare these, you can see right now the volume. Heck, we had 60,000 contracts traded on the 59.90 puts today. 13,000 near the at the money options right now, 60.12, the 60.10s. And even here, 77,000 contracts. And well, you'll notice something interesting when you take a look at the volume versus open interest. And let me go ahead and do this real quick. Let's see. Just want to thicken the column so we can see them a little bit better. There we go. If we want to automate, selling a naked call or put a 15 delta with VIX. I'm not sure if you can automate that entire process, to be honest with you. Not with the Option Station Pro, as far as I'm aware of. As far as the stop loss, you actually have to base it on the underlying security, or actually, you can only do it based on one of the options, not the spread, unfortunately. You can't do it based on the premium of the underlying spread because you can only put in and I'm just going to get to something on that too with placing the stops in just a little bit. But when you do these activation rules, you can put in the symbol right here and you could actually look up the symbol for the option. Okay. And again, you can actually put in if the underlying options premium gets to a certain amount, then go ahead and trigger an exit by putting in a stop order or a market order that will trigger when that price actually gets there. Problem is there's no symbol for the spread. So it's only for individuals, not for spreads, unfortunately. Okay. But what I was getting at right here is you should be able to get filled. What I also was going to make note of right here, take a look at the open interest on these versus the volume. The open interest means those are contracts that have been opened and not offset with a closing position yet or a closing order. Same thing for tomorrow's. They're not even heavily traded yet. No, I'm not, Karen. Haven't been since 2022 or something like that. Anyway, the fact that the volume is so much higher, basically it means that these are being day traded, they're being flipped. People are not holding these long term. This is definitely a very liquid security, and in live modes, you shouldn't have too much of a problem getting filled as long as you're putting in the correct pricing. Now, if I were to do an iron condor, for instance, let me do that. Go with, say, I'll just build it. Forget it. I'll do it myself here. It's much easier. I like to build them anyway. So for instance, if I want to do the bull put spread, and let's say I do 6,000, 59.95. And then on the upside, I'll do 20 and 25 for the calls, the bear call spread. So there we have my iron condor, right? Now, if you try to use this mid price, you have a lower probability of getting filled. Okay. And the problem with getting filled at that mid price, you're basically splitting the bid and ask. If you want to get filled almost immediately, you can put in a market order. Now, that's probably not the smartest thing to do because you could get a lot of slippage when it comes to the actual position. The natural price, if you were to do a limit and natural price, natural is buying the ask and selling the bid. Okay, you're buying from the ask, selling to the bid. That also should get filled relatively quick. It may not be immediate, but it's a little bit faster than if you're just using the mid price. The mid price is usually what pops up initially when you bring up the order tab and you're trying to shave a little bit off and save, which is okay to do. You just have to realize there's a balance there because you are trying to get a better price than what the market is actually offering. You might have to wait for somebody who's willing to basically, what's the word? Compromise. They have to compromise and are willing to take a little bit of a worse price to be able to do the transaction. If you're putting in multiple legs or you're trading, 5 or 10 contracts, yeah, you have a better chance of getting filled by going to the mid price or somewhere in between those. Okay. That's what I was going to say. You might get, that's not strange, actually, getting filled between the natural and the mid. That's actually a smart thing to do. That's what I was going to suggest. That's where I was going with this. It may actually be better if you go between those because you're not getting too greedy, but you're not taking whatever they're going to give you. And I think that's probably one of the better things to do. Often when I do the spreads, because I'm doing them later in the day, this is showing me spreads for tomorrow. If I were doing today's spreads, I'm usually only going to be getting about 35 to 60 cents by putting on the trade later in the day. But remember, the trade-off is there's only 2 hours of market activity to worry about before the end of the day. So if you want to earn more, say you want to get $2 for a spread or even 3, depending on how volatile the day might be, you go in earlier in the day. The risk is prices can move that much further throughout the day. For instance, today, if I go back to my charts, and we'll just enlarge this one. Let's see, $SPXW.X. I really need to put a cover on that window. It's just this time of year. I like looking at all the nature outside, so I usually just keep it open. But the sun is not cooperating today, so I apologize. The good news is I get to look at a herd of deer out there. There's like 10 of them right now, and my chickens. Anyway, so looking at the SPX, okay, this is daily. I'm not going to go daily. Let's go to smaller time frame, say 5 or 10 minute maybe. And throughout the day, sometimes it can be good to identify opportunities earlier because again, the later the time goes by, remember, this is time decay that's occurring in one day. There's a lot of time decay in that very last day. So for today, for instance, there wasn't really any kind of a support or demand zone identifiable. The only thing I really would have had, although I don't have my other chart that I normally work from here, it's on my other computer, but this is an area of supply. We could have sold the 60-15s above that supply zone. But that was not developed until about 11:15, 11:30. There still would have been a lot of premium. Once you get closer to 2 p.m., so here we are about 2 p.m., right there, that is still a viable option, but obviously the premium is going to be much, much lower. It really is an awesome working environment. Yes, Karen. Yeah, I can't complain. So that's the thing. I am willing to trade off a little bit of extra premium for the higher probability of success. And in simulated mode, I'll let you know, you almost will not get filled unless you use a natural price. It's very difficult to get filled in the sim mode unless you use a natural price, unfortunately. So it's not quite as accurate as is with live. I'm not logged in. I can't use my live account on this computer because I haven't authorized it yet. It's on my other one. I'm sorry. I'll show you some screenshots the next time we get together of live trades. So I'll do that. But yeah, it is possible to get filled. As Joe was just saying, it's a good idea if you need to split the mid and natural. The natural is, say, the retail price, mid is wholesale price, right? Well, actually, it's not even wholesale price, but wholesale price is a little bit lower. So you're taking less than retail. You're still getting a discount. You might be getting a 15% discount, not the 25% off, but it's more likely to get in. So, great question as well. Since I've identified a supply zone, when I enter the bear call spread first and then get into the bull put spread a little bit later once I found demand, yes, I could. You can leg into those options, the iron condors, and that way you're actually gaining a little bit more premium as well because you're going to be getting more premium the closer you are to the zone. And you have a higher probability. The drawback is the longer you wait to enter, the more time decays. Now, remember, the time really decays quickly after about 2:30 p.m. Okay, that's where things really drop off. So as long as you can get in before 2:30 p.m., you still have a chance of getting 30 to maybe 40 cents a premium. Doesn't seem like a lot, but when you do that over and over and over again, it actually adds up. And if you figure, I typically do 5-point spreads. Okay, so I've been showing you 5-point spreads. 6,000, 59.95, 60-20, 60-25, 5 points between the two strikes. That gives me maximum risk and maximum margin of less than $500. So if I'm even collecting 35 cents, which is the lowest I typically will want, I'm still going to be getting about, what is that, 7.6% rate of return in 2 hours. So that's worth it for me to only have to worry about the market for 2 hours a day and put in that trade later in the day. But yes, going back to the original question, which I lost. Where did I put it? Come on, I know you're here. Can I get my Word document back up? Ay. What's going on with this computer today? Anyway, but yes, there we go. Oh, nope, that's not it. Where'd it go? Word. Oh, there it is. Sorry, moved off to the side here and didn't see it. Okay. So yes, getting it filled late, again, depending on what price you put in, you may not get filled. If you're just trying to do it in a simulated mode, you could try market, or if you do the natural price, you'll get filled much faster. Sometimes doing the price slice in the theoretical P&L didn't move. I'm not sure about that because in simulated mode, I have not had a problem. I've heard people say they have. So again, if I'm looking at, this is tomorrow's the 28th. So let's go to analyze here. And here I am in analyze, I believe. Is this set up right? Hang on, let me get rid of one of the trades that I don't need. There we go. I have more than one. Not sure what is going on with this. It's looking a little weird on the corner there, but there's the blue should be, yeah, 0 DTE. That's tomorrow. And let's move the graph here. I only need plus 1 day. There we go. So that's the curve right now, the way it looks, or the risk profile, if you will. So if I'm looking at the price slices, I really haven't any problem with them as far as figuring out, okay, well, what's my break-even price? What is my, let's see. We're looking at the break-even on the upside. We're somewhere in the neighborhood here of 60.23. So if I do that, 60.23, there it is. And you just got to make sure it's on the right period. So if I'm doing this on the 0 DTE, I got to make sure the plot is set for the right one. And the legend is right here. I have blue is actually my expiration, 0 DTE. This is now where I have 0.9 days left until expiration. So the numbers will be different depending on which one I'm using. And let's see what's wrong way. There is my break even on the upside. 60, 23, 20. And then that's the theoretical P&L. And then on the downside, I just go there and 59, 96, 86. Or thereabouts. 6, 0. There we go. And then my maximum profit, which is $3.20, the premium I'm taking in. I'm not sure if I, again, did the natural. Yeah, I did actually a little less than natural. So here I can go to the natural price. There we go. Or, as Joe was saying, kind of split the two maybe. So I don't know, maybe go to $3.70, something like that. Now it's changing, obviously. I'll do 350. There we go. Analyze. And that's it. It's working. So again, I just got to adjust now because I adjusted how much I'm taking in premium, so my break evens change. But no, I don't really have a problem with these working. As you can see, the price slices is showing me what happens with the break even prices. But again, you just want to make sure you're on the right plot. I can also go to the current, and there it is. And my break evens on that, they're always going to be negative because again, I'm selling. I need this to expire inside the area between the two strikes that I had sold. So I need time to go away or decay. And I don't know if I can adjust this intraday. Let's see. Oh yeah, there it goes. 0.8, 0.7, 0.6. I'm following it right here on the legend. So now if I close that, it's actually, you didn't see it, but it's going to be raising this curve up and it's getting closer and closer to the blue line. Let's see if I can move it out of the way to do that. Like this. See how the yellow line is rising up? So there I am, half a day, less than half a day until expiration. And there's that line moving up and up and up. So yeah, the analysis works for me. So I'm not sure exactly what the issue's been, but if you identify more or take a screenshot, you can send that to us again in the email, just education@tradestation.com. And they'd be more than happy to forward that over to me to see if I can help you out with that as well. But yeah, I'm not sure what the explanation would be on that. But hopefully I was able to answer some of those questions regarding the 0 DTE. And yes, I will put in leg in when appropriate. Personally, I want to make my trading as easy as possible. So if I can put in the whole trade and get a decent amount of premium, I just do the whole trade all at once. And basically, when I'm looking at this, well, let's see if I can show you. I have too many things open on a browser right now, but we'll find out. It's doing a bunch of work here. There we go. So we'll open up one more. And I think I might be logged in on this one. Oops. It reminds me I'm logged in on another computer. That might be a problem. Like I said, I've got my charts saved on another computer for my TradeStation. That's why I have to use an alternate charting program right this moment. But I have, this is loading up very slowly here. And this is what I was talking about. I've actually got zones saved. This is the S&P 500 or SPX, just as we were looking at. So I'm having trouble loading everything up right now, though, unfortunately. But if I were to go back, you can see I've got, there we go. Oops. I've got zones saved up. That's where we gap down to today. So I could find supply and demand if I need to, because I've saved them going all the way back. Oh, geez. How far back did I go? September of last year, August of last year. Yep. Just a little bit here. So I can still find zones. Yeah, that's February 22nd, 2024. Believe it or not, these are all zones from back then. There it is. You can actually see them. 119, December 2023. I don't delete them because unless they're used, they still may become valid in the future. So yeah, I can usually find them going back, and I have this done on TradeStation as well. Let's see if I go back over here on my TradeStation. Like I said, on my other screen, I actually have all those old ones saved as well. So that's not usually a problem. Now, the last thing I wanted to cover with you guys before we run out too much time here, or run out of time. Come on. Trying to go to my Option Station Pro, minimize all that, and there we are. And that is, I wanted to talk a little bit about managing some of those positions and setting up the stops as well. Oh, yes, you're welcome. The exercise being on simulation, yes, it is. On the price slices, yeah, just practice a little bit. You can practice in the live with the price slices by doing the analysis without putting in the position, if that's an issue. So I could log into a live account and do the same analysis. Just again, when you go to your trade, hit the analysis. If you hit place order, if you've got your pop-ups, you can say, no, I don't want to place the order yet. But you can still do the analysis the same way in a live account versus a sim account, if that may be the issue. And you can see. And if it is, then that's what it is. But if not, then maybe there's something else that's going wrong. And by all means, please let us know. We'll see what we can do to help. So again, going back to, let me see. Oh, no, that's what I want to do. I just want to get rid of this. Come on. What I was going to show you was when we're doing positions, most options traders make the mistake of just getting into a trade and just letting it go. For instance, if I take a look at, let me see, which ones did I put on today? Wasn't this? I'm trying to remember what these were from. CAG. No, actually, let me just go back right here. Actually, I should be able to see them. NEM, no, it was a vertical spread on CAG. That's what it was. One of my options didn't fill. That's why it looks weird. This was a call spread that I put on, a vertical call spread. And I put on a put spread, but for some reason I only got filled on one of the puts. Interesting. That's what threw me off. Anyway, I can see the trades I did today. Newmont, Oxy, that was a single order. So let me see the Newmont trades. There they are. And I have them separate right now. But again, putting these together, there's the call spread and there's the put spread. And basically, all I did right now is simply go in. Let's just take Newmont as the example, since I have that right here. The underlying security right now is at 41.62. I have the 40.50. I believe that's going to be a bull call spread, and this is a bull put spread. And I say that because I see the strike prices. I did an in the money 40 call and an out of the money 50 call. Let me just verify that. Yep, bought the 40, sold the 50. That's a bull call spread. That profits if prices go up, as long as I cover the premium that I paid for this position. Okay, so right now it's in a losing position. That's just because I just put it on as an example. I wasn't actually trying to make a profit here. The bull put spread, I sold the out of the money option, the 40 put, and then I bought the deeper out of the money 35 put with the intention of having this expire with the underlying security, which is currently near $42, just being above $40 before expiration. Now, one of the things that people do often I see when they do these debit spreads, first of all, they buy options that expire too quickly. So you'll notice I went out a bit in time here. I went to the 17th of April. That gives plenty of time to be able to deal with this particular position. So if I go again to Newmont and looking at the options, as soon as they load, while I'm at it, close all windows. See if that'll do it. Oh, close all. There we go. Anyway, there we are. So now I'm on Newmont. And again, we have options that expire in 3 days. The problem with these options is time. It doesn't give enough time for the trade to play out. So, I'll go Vega, Theta, and Delta. Oh, Delta's already there. There we go. So get rid of volume and open interest for now. And there we are. That's what I want to focus on. So again, Theta, is kind of high in relatively speaking. I mean, it's only 8 cents, but it's relatively high when you take a look just a week later and you got 4 cents. And further out, 3 cents, much further out where I went, 2 cents. So I'm not losing a lot in premium every single day as that position goes on. I will pay more for the option, as you can see. In this case, the bull call spread, it was long for about 370, short for 53 cents. So the net is a cost of 307. Again, if I did the natural, it's 317 right now. Okay, so I'm paying a premium to get into the position, but I'm buying enough time that I'm not going to waste that 3 cents every, or more than 3 cents every day. I'm losing that no matter what. Actually, I'm not losing that much. I should take that back because my theta changes, as you can see, because I'm getting negative theta, but I'm gaining positive theta. So I have very little time exposure by buying that extra time. Will it be as cheap as if I did this shorter options? Heck no. What did I get here? The 40/50s. Let me get enough strikes here. There we go. 40, 50. And remember, the other one was what, $3 and something? This February 7th is only $1.98. So it's costing a lot, well, 216. Okay, it's costing over $1 less to get in the position, but my theta, look at how much time decay I'm getting now. It was only 60 something cents. Now I've gone all the way up to $2.80. So that's eating into my profits, and it may be eating in too much, as you saw with the straddles that I did earlier. We're going to talk about that again next session, but we got to make sure we buy enough time that we don't have to worry about that time decay eating into all of our profits. So going back to my original position that I was putting on, a couple of things I want to make sure of. When I get into a position, typically I want to know 3 things before I get in: where I'm getting in, where I'm getting out, if I'm right, and where I'm getting out if I'm wrong. Even on options, I still do the same thing. I want to know those 3 things because I'm doing my analysis on the underlying security. And I've mentioned this a few times before. When I trade options, I do 3 steps. Step 1 is my analysis on the underlying security. Am I bullish, bearish, or neutral on the underlying security? If I go to Newmont there, okay, I take a look at the underlying security. I was doing this on a daily chart. And honestly, I wasn't really doing proper analysis on this because if I were, I wouldn't have put in the trade yet. And the reason why is we're not actually at a demand zone yet. That's down here at about 38, 39 bucks. Okay, and I did 40s as a simulated, demand. But hypothetically, if this is where I was going in and we were near that area, I was putting on the bull call spread. When you get into a debit spread, you're at maximum loss, theoretically, right? Because you can't lose any more than you paid for the option, but you don't have to lose that much, right? I also should know how much I'm potentially going to gain, especially in a bull call spread, because you can only gain so much because you're capping off where you're going to be basically ending your profits. I sold the 50s. I can't make any more than that. As a matter of fact, there's a bit of a resistance level or supply, excuse me. It's not really resistance. I use supply and demand, slightly different. You can look up in social media. You'll see I've done stuff on that before, work on that before. Anyway, but right here, you can see that it's probably going to get up to 47.75 and then die off and fall down. Well, if I put on this position, basically, I can use the price slices to figure out theoretically how much I might make when we get there, if I know that's where my exit's likely to be. So let's do, which one did I do? The Aprils here. Again, I'll recreate the same position, 370, 53, natural, and actually analyze that. Or what I could have done a little bit simpler would have been to go back to the position, just analyze a duplicate position, because I actually paid 307, I think, for that. Oh, no, trade price was 313. Okay. So let's make it 313. That's fine. There we are. Is that it? That does not look like the bull call spread. Let's see, zoomed in. That's why. Now it looks like a bull call spread. As long as I can see 50. There it is. So there we go. All right. And I'm not holding this till expiration. There's no way. I want to hold this until there's the maximum. I still want to get out when there's at least 30 days left till expiration. The reason behind that, again, is that time decay. I don't want that eating up all the profits. So I'm going to maximize this and bring this up to maybe 35 days left till expiration, March 13th. So I'll be sure I'm out by then, worst case scenario. Hopefully before that. I can even guesstimate how long it will take. It's a little bit more in depth, but I can look at the average true range and how long does it usually take to make that kind of a move. We're trying to go up $6 roughly, 6.25 almost right there. How long does it usually take to move $6.25? I can take a look at previous moves to the upside and guesstimate that. It might take a little over a week and a half, maybe 2 weeks on the tops. So I can try to figure out, okay, 2 weeks from today, figure out that date and plug that in and do my price slices there. Now, I'm not expecting it to go all the way to $50 where I sold that option. It's probably going to cap out at $47.75. So let's see at $47.75, roughly what kind of profit I'm looking at. There we go, $47.75. If there's, March 13th, it probably wouldn't even take that long, as I said before. I could even bring in another day and take a look, but my potential profit is $359.02. Okay. So one of the things I can do is exit if we get up to that supply zone. So I can set up a target to exit no matter what the price is, or I could put in a limit order at this theoretical P&L or nearby, so that way I get out that price or better. Okay. Usually I'll just use it as a market order, and I know that theoretically it should be about that profit, knowing that it may be more, maybe a little less. All right. Now, how much am I willing to lose? Well, typically I don't want to risk more than 1/3 of my potential profit. So what I can do then is calculate that. Let's see. Oops. Here we go. Calculate. And we're looking at a potential profit. I'll just call it 350. So divided by 3 is about $116. So I just need to figure out, where would I lose roughly $116 by sliding this and going to the theoretical P&L. There we are. Whoop, wrong way. Yeah, that's good. About 40.50. So 47.75 is my potential target, although I may want to exit before that, and 40.50 on the downside. So now what I can do is go to my open position, and I can only do this once I have the open position, by the way. Okay, so I get into the position first, and there's my bull call spread. Now I can right click and close this position. So what I've done so far is, and I would normally do the analysis before I get in, but since I already got in, I went and I can analyze a duplicate position, or I just created the duplicate position. Under the analysis, I figured out, okay, where am I likely to get out and when? And honestly, like I said, the date's probably off. I could probably do a better date, but I'll just stick with these numbers for now. Okay. And I can try to guesstimate, let's say I'm getting out around the 14th of February in about 3 weeks. I would figure out what the profit potential would be on that day at that supply zone. That's it. I just changed my graph right here to that date. 14th, Valentine's Day. There we go. And now I see 47.75 would make about $317. So I would want to risk no more than like $100, right? 1/3 roughly. I could do about 105. There we go. That's about 1/3. So I'll put my stop loss now at, let's say, 39.80. Okay, so I'm getting out at 47.75 or 39.80 on the downside. And that way I'll either make 317 or I'll lose 107. I know it's not quite 3 to 1. It's okay. So, oops, I want to stay on this one. I will go to my managed position. Again, right click the position, close this position. And I can just change this to a market, or I could put it as a cost. Again, how much it would cost me to buy it back as a limit order. I'm just going to do it as a market order because I know approximately what I should be getting. And under this activation rule, I forgot to click that first. Sorry. I got to activate the activation rule. So I use price slices to figure out my potential profit and my potential 1/3 risk if we get there. Now I forgot what the number was because I forgot to write it down. 39.80. That's what it was. 39.80. Okay. So right here, price NEM. And I'm going to do it twice, one for the stop, one for the target. If Newmont gets greater than or equal to, and I said 47.75, that's my target, or, and this is a key thing, you got to make sure you do or. If you do not do or, it will let you put in the order with an and, but prices can never be in both places at the same time, just like you can't be in two places at the same time. So instead, I'll do this. If the Newmont price goes to 47.75, or if it drops below 39.80, I can do equal to actually, or less than or equal to. And that's the condition now. That's going to activate the order. What order is it going to activate? It's going to activate a market order to close out that position. And I want this good till cancel as well. Day order is no use. It's only for that day. Although if I'm doing 0 DTE on the SPX, I can do that day order. But by doing this now, I place the order. It's basically saying, I will sell to close Newmont, the call that I bought. I will buy to close the one that I sold if Newmont gets equal to or greater than or equal to 47.75 or less than or equal to 39.80. STT, I should explain that real quick. In here, you've got several different types for the trigger. It doesn't happen as much anymore as it used to, but market makers, who are the brokerages and firms that create liquidity in the markets, they like to play games sometimes, and they will do trades and not report them immediately to the exchange. Your charts are made up of trades that have been reported to the exchange, and they're all supposed to be reported within like 90 seconds, or at least I think it's 60 seconds of occurrence. The problem is brokers don't always report them right away for whatever reason. Sometimes they're holding back because if prices are moving fast, they can late print or late report an order, and it triggers stop losses because most people's stop losses are based on that, like we're doing here. Well, you can do specific things saying, now you've got to leave your computer on for these to work, by the way. Okay, you can't just set it and forget it. You got to let your computer stay on with this to be active. But basically what this is saying is, if you have a trade, it has to be within the actual national best bid or offer. So within the spread at the time the trade comes through, otherwise it'll be ignored. Or it has to happen twice or 3 times. I'm sorry, no, it's just twice. Double bid ask or twice bid ask within the NBBO. So you got to actually either have it show up on the best bid or the best ask, or a trade occurs more than one time inside that best bid or offer. If you're not sure what these mean in detail, you can actually go to the little help right here, the little question mark, and type that in. It'll tell you. There's a whole list on that information. So you don't really need it as much anymore as you used to. But that being said, it doesn't really do anything if extra. It doesn't hurt you by having it on there. It can only help you, really. So double trade tick within the NBBO, it might delay it a few seconds, if at most. It might be milliseconds to get delayed. But by doing that, either single trade or double trade tick within the NBBO, you're making sure that if one of those market makers is playing games and throwing in late prints, you're not going to get stopped out by mistake. Okay. So it may be a good habit to do that. I've honestly haven't done that in a while because I haven't had too many late prints recently. I don't see them too often anymore, but it does still happen from time to time. So anyway, I do that and I place that order and I did GTC, right? Yep, GTC, and it's there. So basically now I've got to stop in a target. Oh, got rejected for some reason. I'll have to check why. Maybe because I did market order. I might have to do a limit order with the price anyway. But the same, and by the way, I normally do this right after I put in my order and get my order filled first. So it's no big deal. The same thing, if I'm doing a put, let's go ahead and analyze a duplicate on the put side and get rid of the call side first. Now, on this put, I did a trade and I received $1.29 credit. So I can do the same thing. If I know, and I actually did the wrong option on this, I should have done a shorter term option, but that's irregardless. What I can do is the same thing. 1/3 of the potential profits are roughly 40 cents on the loss side, or $40, excuse me, wherever that may be. Which again, I didn't put in a great trade right now. So yeah, it's actually right about here, roughly about 39.72. Now, do I think prices are going to get all the way up to that 47.75? Probably not. In this case, when I'm doing a bull put spread, I'm selling options. I just want this to expire worthless. So I may only put the activation rule for a stop loss if it goes down, in this case to 39.72. So I do the same thing, right click, close this position. Okay, again, I have the open position. I put in the close, market order. Oops. Good till cancel. Activation, though, if the prices go against me. So if this is Newmont going less than or equal to 39.74, and I could do the NBBO or I don't have to, it's up to you. Hit OK. And it's probably going to reject it because I am doing a market order, but I could put in the limit order, like I said, and I collected a premium of $1.29. I could just add, what was it, 40 cents that I was looking at? So if I make this $1.69 to buy it back, I can put that as a stop limit because it won't let me do a market order right now. GTC, it should let me do it though. I don't know why it didn't. Let me just try it again real quick.
Order rejected.
Yeah, order rejected. I don't know. I have to check to see what the reason was. Anyway, I've run out of time, but this will normally work no problem, using that activation rule to set up a stop loss to protect yourself. And there are videos on this as well as in the Options Education Center, but I wanted to kind of walk you through how I go through the process, again, of first analyzing the security, just analyzing a duplicate of your position you got into, figure out where or when you want to get out, and then just set up the activation rule for it. So again, if you got more questions on that or anything else, please email us. Again, it's education@tradestation.com. I'm going to turn it back over to Jesus. And I want to thank everybody for being here. If you got questions on any of that or things you want us to cover in the future, let us know. We'll see you again in a couple of weeks, right?
That's right. That's right. And Brandon, if you hover over that message at the bottom on OS Pro, does it tell you the reason why it got rejected? No.
I think I have to go to my messages in
Trade Manager, yes.
Yeah, the trade manager. I'm pretty sure that's where I have to go. Whoops, I just covered it up too. So
Maybe the simulator is not taking after hours orders, but it's a GTC, so I agree. They should have taken it as an order to activate the opening of tomorrow, right?
right. So oh wait, that's not where it is. I forget where it is now.
Yeah, right there. Messages. You have to just open up the message column.
Oh. Market orders for open transactions Monday through Friday between. So it'll only be done during regular trading hours.
Yeah. Yeah.
So
Yeah.
and that's when I normally put it in. I don't put in my stop after hours. So yeah, they're only going to accept those hours or those trades, unfortunately, during regular trading hours to place the stop loss. So like I said, as soon as I get filled, I usually put in that order to get the stop loss in immediately. Yeah. So yeah, that's why it doesn't want to take it after hours.
That's pretty cool. Okay, well, great information again, Brandon. Brandon went through a lot of platform functionality that sometimes is overwhelming. You know, that dialogue where you get all these different trigger types. If you haven't seen that before and you look at it for the first time, you know, it may be a little bit overwhelming and confusing. But the options there are simple, and it just gives you a little bit more flexibility as to how your stops get triggered. So it's just a little bit of the testament of TradeStation, allowing you to make the TradeStation platform the platform that you want to trade on and that you're comfortable with. So, Brandon, again, thank you for your time. Thank you for being here. Thank you, everyone, for attending this session. And I hope to see you in one of our future classes. Check out our events calendar. We have great upcoming topics, including an options presentation on Wednesday at 2 p.m. On what is it? What is the option strategy that we're going to show on Wednesday? I forget. It's not conversions, because conversions is towards the end of March. I
I
think
totally forget, actually. I got to look it up now.
synthetics, right?
Oh, synthetics, have we not done that yet? Okay, yeah, that must be it.
Yeah, synthetic positions. I think just go to the events page and you'll see the topic right there, Wednesday at 2 p.m. So we look forward to seeing you there. Again, goodbye, everyone. Have a wonderful afternoon. See you next time.